Hi, listeners. It's Stephanie here from Hotel News Now with a quick correction to data you'll hear in today's episode. In the first segment, Isaac Collazo says economy segment supply is down 3.1% from 2019, but in fact, economy supply is down 8% from 2019. Thanks and enjoy the episode.
Hello and welcome to another fun-filled episode of Tell Me More, a hospitality data podcast. I'm Stephanie Ricca, as always here with STR's Isaac Collazo and CoStar's Jan Freitag. Hi, guys.
Hello, Steph.
Hey, Steph.
So I feel like it's been a long summer. We are recording this episode on September 19th, so it technically still is summer for a few more days, but I don't know. This summer has just felt long for the hotel industry, long for all of us in general. Are we almost done?
Are we there yet?
Are we there yet?
I don't think it seems short to me. Although I know, I love summer. It's fun. Yeah, no, it's now it's getting dark, cold. I'm not ready for that.
Well, now our optimistic Isaac Collazo has re-entered the chat, and I think that it is the perfect transition to throw the mic to you and get you to talk about the latest data highlights, because you've really queued it up by saying you're happy with a sunny summer and you're not looking forward to the cold, dark winter. So is that what we've seen in the last month's data?
Possibly, but let's go through the numbers and then we're going to talk about it more in general later.
Okay.
But as everyone's probably already seen, August for the U.S. industry was very good. It was RevPAR was up 3.9%, which was the second highest of the year behind May's 4% gain. So again, a very solid August. But wait, don't get too excited, because August benefited from an extra weekend. We had 5 weekends versus only 4 last year. So that fifth weekend really does give a lot. So what I did is I looked at the data on a day matched basis, looking at the same days, regardless of the calendar date. And on that basis, RevPAR was up only 2.3%, or 1.5 points lower than what we actually reported. What was interesting also is this month's variance on a day match basis versus date was one of the largest so far. It's really interesting to see that. And again, it's just that weekend. That's how strong weekends are. Even though weekends have been trending down all year, they're still very strong producers. So again, it does matter how many weekend days you have in a calendar month. And then I also looked at a different way of looking at the 3 full weeks that were matched both in 2023 and 2024. RevPAR was up about 2.4%. And so again, it's that 2.3, 2.4 probably is a more realistic number than the 3.9, but we'll take the 3.9% to the bank. It helps with our month-to-date number or year-to-date numbers.
Yes.
The drivers of RevPAR this month around, again, was ADR. 60% of the RevPAR gain came from ADR, which was up 2.3%. Occupancy finished the month at 66.9%, which was up 1 point from a year ago, but still down 4.1 points as compared to 2019. Top 25 markets, again, the second broken record, again led the industry. RevPAR for them was up 5.1% versus 3% for all others. Oddly enough, both groups, top 25 and non-top 25, had basically the similar ADR growth of 2.3. I mean, there was no difference really. It was really top 25 having that higher occupancy as groups and meetings keep coming back, more people going back to the top 25. That's what drove it. Another fun fact, for the first time since March 2023, all chain scales saw RevPAR growth, ranging from 4.5% in upper upscale to 1.9% in economy.
Finally, economy gets a little lift.
Right,
Yes.
it did. And then what was interesting, other than economy, every chain scale RevPAR was above 3%. So while economy was up, it was still on the lower side. And I'll get a little deeper. Obviously, Steph, you're baiting me on that one. So this was economy's first RevPAR gain in more than a year. And it was again led by ADR 1.2% because occupancy was down. And so what's interesting that demand was down. Even though demand was down, occupancy was up, demand was down. I get that right. And the reason occupancy was up because the decline in supply was greater than the decline in demand, right? So
Oh,
you have
so a mathematical
yeah, so supply
benefit.
was down 1.3% from a year ago, and overall from 2019, it's like down 3.1% if I got that number correct.
Hmm.
So, but again, we'll take it. It's great to see it come back. So, positive is a positive. So this is the optimistic Isaac. We'll take the positive. We'll again take it to the bank. And then the other thing that's exactly what we've seen all year long is group demand among luxury and upper upscales was good, and it was up 3.6%. So again, very good group demand. And then, Steph, do you want more? We have a little bit more. I think we need to expand our review of the industry. Why don't we
Tell
talk a
me
bit?
more.
Yeah,
Tell me more.
Jan, nothing. God, nothing from Jan. Jesus.
More.
All right,
More.
more.
He knows he
Global.
can't argue with the data. We can argue about other things, but the
Well,
data is the data.
Well, first of all, before I finish, what I'm going to add is some global data. So we know there are people out there that are listening to us, and so let's give a little bit of global perspective. So for year to date, global RevPAR, and we use 128 comparable countries. And you go, what do you mean comparable countries? We're really looking at countries that have sufficient data for 2019, 2022, 23, and 24. And that way, when
Okay.
we're looking at percentage changes, there's not because one country is now reporting that we didn't have data before. So it's comparable. So 128 is very representative of the globe, especially the hospitality. RevPAR globally in that basis was up 5.3% and basically on ADR growth of 4.5%.
Over 1 year ago at this time,
Yes,
or
over a
versus?
year ago.
Okay.
Correct. And among the 10 largest countries, again, the 10 you would expect, like UK, Japan, Germany, so all those countries, RevPAR was up also 5%. So again, basically like the globe, but you had real standouts like Japan, RevPAR was up 18.7%, Indonesia, 17.5, Thailand, 14.3, Spain, 12.7, Germany, Jan, your homeland, 7.8%, UK, 3.2, and then in our backyard, Canada at 4%, Mexico at 2.4%, and the only among the 10 countries, the 10 largest, the only decliner was China at minus 4.2.
Which
And
is
now to
what
give you
we've been hearing across the board
right, and you
in
heard all those
related
big
metrics.
numbers, right? US year-to-date RevPAR is at 1.5. So again, if you include us in the top over that,
Mhm.
US is also near the bottom, not negative, but again, the bottom of that. And that just speaks to how the US now is more in a normal pattern, normalizing all those words we used a year ago. The rest of the world is just getting there. So you'll start seeing lower RevPAR growth soon, but right now they're still very high. So that's
That
kind of what
wave
happened.
across the globe. I think that's really interesting to put in perspective. I'd love to start talking about that more every month. Jan, what stood out to you from what Isaac shared, either the domestic US data or this global snapshot?
Yeah. So should we talk about Taylor Swift again?
Oh my
See,
God,
Oh,
yes.
now
It's
okay, fine.
that's
But she's
that's
part of that.
that's
She's part of
it.
that.
The
She's
wave.
absolutely.
Demand follows
So,
the wave.
okay, done. That was the Taylor Swift comment. I think the China data is very, very interesting. That has quite a few people spooked a little bit because it implies that if the Chinese economy is not as strong, there are a lot of countries, and I think the US used to be one of them, that is sort of hoping for the return of the outbound Chinese traveler, right? But if they can't afford to even go on a domestic vacation, they certainly can't go abroad either within APAC or abroad to Europe or to the US. So that's definitely worth watching. I think closer to home, two comments I keep making just because I think they're important. Number one, supply growth in August, 0.4%. So really de minimis, not a big deal. We are not overbuilding, long on average, 1.7%. So we are a far cry from that number. Now, the interest rate cut that we will talk about in a minute may put some fuel into that fire. It's going to be a very slow burn, to stay with the metaphor. And on the group side, I think, Isaac, you sort of said group was healthy. Let me just throw out group RevPAR up 6.8%, driven by ADR up over 4%. So pretty, what's the term, stout performance on the group side. And you and I think, have continued to point at group demand for the higher end full service hotels as sort of the base that then allows hoteliers and revenue managers to yield up when the transient traveler comes, and you layer that on top. However, unfortunately, and that may sort of break up the segment, we already have the first 2 weeks of September data, and that does not look so great on the group side. But I'm making this a little bit too negative than it is. But I think that for the August data, group up 6.8, very, very positive note.
Let me make a few comments, because I think what was interesting this week, RevPAR was down 1.4%. Is that the right number? I think that's what we had. Yeah. This week, RevPAR was down 1.4%. What was interesting, Jan, is the only bright spot in this week's data was group. It was the second highest total room demand sold this year on a weekly basis. So even though, yeah, if you're looking at month to date, it's still, because the prior week had Labor Day, so no groups and meetings. But I was actually really surprised when I saw that data come through, that this was actually a good group week this past week, ending the 14th of September, and that it was positive, again, from an absolute numbers standpoint, So that's a positive. And then another positive. So here's the optimistic Isaac. Is that a blue sky? I'm looking out there. Hold on.
Oh, wow.
As China, even though China's occupancy was still down, after 29 weeks of declining ADR, this past week and in the 14th of September was actually flat. That's a positive. So maybe some things are turning around. And I was just looking at that data earlier today. So just a couple of things that you'll read about when our summary of last week's data should be out tomorrow. So.
And one thing I do want to point out for our listeners, I'll give a little plug. Interested in learning more about unpacking that hotel performance across the Asia Pacific, listen to Hotel News Now's monthly podcast. We do one with Jesper Palmquist of STR, who knows everything about that region. And for the last couple months, they've been talking about, Sean McCracken on my team talks with Jesper about the data, and they've been talking in particular about Japan and Indonesia. So it's great to check that out. I will drop a link to those podcasts in the story. All right, Jan, you are up first this episode to share your interesting topic of the month. And I've got to say, we've really buried the lead here. I hope we can talk about the interest rate cut now. So let's just put it into a little bit of context. Today is September 19th when we're recording. So yesterday, we heard the news that the Fed did a larger than expected interest rate cut, which is being lauded with open arms, hailed across, I won't say just the hotel industry, but pretty much from sea to shining sea. So Jan, give us the highlights.
Yeah, I think the Federal Reserve Chairman thread the needle on this one, because the investor community expected with 100% certainty a quarter basis point cut. And the people were worried that if they would cut more, that would signal that things are falling apart on the labor market side. And so then that the stock market would, go wild on the negative side. Well, it turns out that didn't happen. They're basically saying, oh, well, maybe we should have cut in July, but this is going to be sort of an orderly unwinding of these higher interest rates. So they cut 50 basis points and more cuts are in the offing. So what does that mean for the U.S. hotel industry? Your colleague Brian Rutan wrote a really interesting article about this today in Hotel News Now. It's a bigger than expected interest rate cut is welcome news to U.S. hoteliers. Why is that? There are really two topics. One is asset transactions, and the other one is the pipeline. He's quoting our friend Abi from from Noble, who basically says, this is good news. This will drive more transactions in 2025, probably in the latter part of 2025, which is a little bit ironic because if you remember back at Alice in January of 2024, everybody said, yeah, the transactions are coming, later part of this year. And then at NYU, people were like, well, maybe you're going to be early 2025. And now we're saying, well, maybe it's later part of 2025. So now we actually have a rate cut under our belt. I think that will give people A, comfort that the interest rates peaked, B, that it's really, what's the opposite of pencils down? Pencils up, I guess, that people are ready to underwrite deals again. Obviously, on the luxury side, we've never seen a slowdown, right? Host Hotels has been super active. Hyatt's been very, very active selling their properties. Host very active buying properties. So on the upper end, that was never a problem. But this is really one of the limited service type properties where we expect a lot more activity. On the pipeline, this is going to take a minute, right? I said supply growth 0.4% for the month, with 0.5% year to date. The number of rooms in construction has been between 150 and 160,000 for 32 months, almost for 3 years. We've seen this sort of very mild oscillation between 150 and 160,000. At the same time, the number of rooms in the planning phase stood as of August at 330,000, which is up 40% from a year ago. And I absolutely expect that as the interest rates come down, more people are going back to the bank and saying, hey, can you get me construction financing for my project? I was talking to the chief economist for CoStar earlier today, Dr. Cooper, and she said, yeah, Jan, but isn't it true that people are expecting even further cuts? You know, and so why would they lock in an interest rate today? And I think that's a fair point. You know, so maybe some developers are saying, okay, let me wait just a little bit longer, maybe another quarter or two. On the other hand, if you can get, you know, construction financing that's maybe on a floating basis, you know, that where the interest rates resets, you know, maybe you can take advantage of that today and jump in. Because what I keep saying at these industry conferences, when I talk to lenders and investors and owners, is like, if you can get into the ground today, you'll be the first one to open, and you'll be the shiny penny. You'll be the new kid on the block for quite a long time, and hopefully can capitalize on that. So the outlook for the hotel industry on the transaction side is positive, and on the new construction side continues to get better.
Going back to that statement we started this podcast with, you know, the end of summer, you know, we would say winter's coming, but I would say supply is coming. Because if you look at the pipeline and you look at how many projects are in the planning stage, which is they haven't broken ground, they haven't fit planning. Globally, there's 1 million. Was it 1 million rooms or 1,000? Let me see what 1 million rooms. Yeah, got to make sure 1 million rooms. I've done that slide multiple times. I had to check my slide. And then there's 488,000 in the final planning. And so looking at the US, just the breakdown, 1/3 of all hotels in construction or final planning are in final planning in the US. So it's just waiting. It's that lag time, just waiting for it to get pushed. And then you'll start seeing some of these planning hotels go into final planning. But the net is supply is coming. It's just a matter of when. It won't be probably not 25. So we don't have to worry about that. But by 26 and 27, I would think you'll start seeing more significant supply growth than what we're seeing today.
But it's not quite just a open faucet, right? Just because cost of debt is lower doesn't
lending
just
standards
equal, right? Lending standards are still in place, equity requirements and so on.
Correct. Yeah, it's not. Yeah, and again, and everything with the interest rates, right? I think to me, what I thought about when I heard the cut is it's a confidence boost, but nothing really changes, right? For most people, your mortgage, your car loans, your credit cards, nothing's going to really change unless you buy
that
something.
Unspooling. The word Jan used was the unspooling from here. This is the symbol, and then it keeps going, and you see the people jumping in, the people waiting, and
right. So there's a lag.
Yeah, to me, the way I describe it when I talk to industry participants is that it definitely changes the psychology, but it may not change your spreadsheet.
Right. I 100% agree.
That psychology, like you mentioned, of course, over the last 12 months has been very top of mind as hoteliers are looking for any signal, any cue to do this. And of course, a year ago today, we thought those rate cuts might happen sooner in 2024 than they did. But even by June, we knew it was not going to be until tail end of third quarter, start of fourth quarter. So I don't know. We've seen even so far this year, like you mentioned, the luxury transactions, there's been maybe 7 or 8 over 200 million. I think people have found a cue or a reason to jump in already. So this will accelerate that further. But
yeah, I mean, you saw the
deals have
Hyatt
always happened.
You saw the Hyatt sold for $1 billion
Right. And that
in
was
Orlando. Jonathan Gray from Blackstone, who's probably one of the smartest guys in any room, right, has said, and this is now for almost 2 quarters, that they're absolutely ready to deploy capital. They're risk on, and they're early, in the cycle, and they have been active participants, and I think they will continue to do so. And that gives a lot of other people then confidence. If Blackstone's moving, they're moving too.
exactly. And REITs hitting the ground as well. Okay, Isaac, you are up for interesting topic of the month, and I have a feeling you are not quite ready to give up on summer yet, are you?
No, I am not ready to give up. I'm ready to go to the pool, go to the beach still. It's not the end. It still feels like just the beginning. But that being said, we did some analysis on summer 2024. How did we define summer? First
The
of all, we
summer
looked
of
at
24?
24. Yeah, summer of 62 or 64 would be
62? Was it
69, I
62 or
think.
60? Oh, summer of 69.
59.
Oh God, I know we're so bad. How can we
How did
forget
we
that
not
one?
know that?
I know.
What do you
Thanks,
mean?
Jan.
I did? Hello?
Jan remembered.
All right, we'll try that again. No, the way we defined it is we looked at the days, the 101 days between Friday of the Memorial Day weekend till Sunday of the Labor Day weekend. And we did that for every year. STR has been tracking or has had daily data now for 25 years. So we went all the way back 25 years ago to look at every summer of the past 25 years. And what I can tell you, and I'm going to look at specifically at room demand, because again, we're trying to see are things really changing that much? Well, room demand for the summer of 2024 was 390 million room nights. That's the third highest. And so we began record keeping in 2000. So I think
What
let
were
that sink in a little bit. And the highest ever recorded, so 390 this year. In 2018, it was 397. And in 2019, which holds the record, was 401 million room nights. So yeah, there's a difference.
Oh,
But given
Wow.
some of the
That's a
weakness,
big difference. I did not realize we were that far off.
but no, that's
ladies
not
and
that
gentlemen, Jan's mind is blown.
10 million room nights, 11 million. That's not that bad given the economic. So here's Mr. Blue Sky again here, coming here. I mean, we have some weakness on the lower end. We have this high inflationary environment, which is keeping people out from traveling because they can't afford it. So I actually thought that was a very positive number given what we've seen lately in the numbers. So I actually thought this was good. Yes, it's still off, but not horribly off. If it was 350 million, I would say, oh my God, we're way off, but we're not that far off. And again, Jan, the other thing I looked at, I did on a per capita basis, and I used total employment because the way I figured is people who travel have to be employed. Now, of course, I'm sorry for the retirees who travel. You're not included in the per capita calculations in this case. But the industry sold 2.5 rooms for every employed person this year versus 2.6 in 2019 during the summer period. So again, it's not that bad. It's
That
actually
feels
say it like
close to
that.
me. That feels close to me, but
Yeah.
I'm just the journalist.
Yeah. And then now occupancy is going to look a little different. So occupancy this summer was 68.2%. And again, this is a positive for me. It's flat to last year. Given the economic struggles people have been going through, given all the outbound, it was flat. So again, didn't set any records per se, but again, flat to last year. I'll take that anytime. I mean, you're looking at me like you don't believe my data, Jan, but
No,
believe me,
of
it's
course
true.
I believe you.
I know, I'm
Trust
just
the
giving you help.
data.
But again, back to 2019, at that point, occupancy was 72.3%. So, I mean, that's a gap there, but we've had supply. And essentially from 2014 to 2019, summer occupancy had always been above 72%. So we have some way to go. But again, I thought it was really well done, or not well done. That was a good, decent summer. ADR was up 1.2% this summer, and that's slightly lower than a year ago. But again, slightly lower than a year ago, but exactly like what it was in 2019. And I've found a lot of similarities between 2019 and 2024. And I've been talking about that in the past. So I thought, okay, this is good because 2019 was also a weakish year, like this full year looks like it's materializing. The other thing we talk about, we looked at the 25 Labor Day weekends that we have data for, and this was the fifth highest in terms of room nights for a Labor Day weekend. And again, that to me, again, it's top five. I'll take it. Given everything we've been struggling with, the high interest rates, the slow unemployment, the high inflation. Hey, top 5 is okay for a Labor Day weekend. So I thought that was a good thing as well. And I think that was it. I mean, uh, it was, I think, looking at all the ADRs and things, yeah, they're still down, especially when you adjust for inflation versus 2019. If you look at the nominal ADR, nominal RevPAR, yes, this summer was the highest ever, but that's because there's inflation and there's other things. So you really have to look at it on a nominal basis. So
Let
that's
me
what I
ask
have for the
you
summer.
let me ask you a quick question, Isaac, and this is where the podcast format fails me because I'm going to ask you to sketch a visualization for us. You looked at the last 25 years. So that would have taken you back to 1999 or so. Can you describe I don't know, maybe this isn't the best way to do it. Can you describe, you talked about these highs, top fives, top threes being within the last 5, 6 years. What does that chart look like when you're looking from 1999 to
Oh,
today in terms of summer? Is it just a continuous grow or is
yeah.
it
I didn't do the
notable
CAGR.
dips?
Yeah, I did a CAGR on Labor Day, but I don't think I did it on the summer thing. But yeah, it's definitely high, much more demand, right? So if
Hmm.
you go back, demand has been growing for summers.
That's
There's
what you
no
can
doubt.
see. Summer
Right,
demand just
right.
do.
And you see the
Yeah.
dip. Again, 2019 would have been the apex, right? 401
Right.
million. And that was what's interesting about that one, now that I'm thinking about it, is again, that was a year where hospitality wasn't doing great. I think year to date at that point was 1.1% RevPAR growth, just like what we're seeing today, but that summer was much stronger. Part of that, as you think about it, try to rationalize that, you had you had normal inbound, which we don't have right now. We know that we have abnormal outbound. So you
Hmm.
wonder if that mix, that inbound outbound mix was more normal, would we gotten closer to 2019? Unknown, but
Right.
and then you also have, I think, as we talked about in the previous podcast, I do believe that a portion of room demand, a larger portion of room demand, is going to short-term rentals, and some of that just it's an economic play. That's people still want a vacation. That's piece of it too, and then also the very strong growth in the cruise market since
Hmm.
2019. So you have to believe that's taken away some of the demand.
Well, and
So
especially if you look back to 1999, I mean, not
yeah,
necessarily with cruise, although there's
yeah,
higher capacity, but the alternative accommodations piece.
Certainly.
So there's
yeah.
a lot of conversation to lay over that chart.
Yeah, but it's again, I think it was good. I mean, that's where I've
Hmm.
become a little bit more optimistic. Yeah, it's not the best, but you're still top 5, both Labor Day and summer. It's like I'll take out on room demand. You again, that's why I did the per capita, because you could argue, well, the population's bigger. So that's why I did the whole per capita piece to kind of see how different that delta was versus 2019, because we know that's grown as well. So
Yeah, in
you're
general, I would probably think that the GDP growth line compared to that demand line, Steph, probably, lays over each other
Right.
pretty.
Oh, for
There's a
sure.
pretty high relationship, pretty high
Hmm.
correlation, except for arguably 2021 onwards. As we know, the GDP growth versus demand growth number has sort of decoupled.
right.
But, I don't think that that's forever. But looking back in time, I would always go back to GDP. I like your idea of looking at people who are working versus room demand. I think that's an interesting stat that we should keep an eye out when that comes back to where it was before
Yeah,
pre-pandemic.
and I have that for the total industry. It's a metric I've always looked at. So I look at it every month. We just don't talk about it very often because obviously during the pandemic it didn't matter. But now, okay, we got to start. It's a good way just to kind of, because we know populations are growing. It's like, how do we balance? Is this good or bad? And so that's
Hmm.
why I kind of look at that way. But we have to remember, it does exclude retirees because technically they're not in the workforce, right? Unless they're working. And you know that there is demand from
Right.
retired people that is just being missed in that per capita piece. But that's the way it is. So,
So interesting, though. I think there's a lot of different angles you could look at that from. But interesting. So
yeah,
summer, but now, unfortunately, in 2 days, 2, 3 days, summer
yeah.
draws to a close, and we will move on into the fall season. I want to go back really quick before I throw out my topic of the month and ask you guys about typical cadence of group demand in September. Because one thing you talked about couple minutes ago, Isaac, was that interesting peak last week in group demand in September. And of course, we know that business and group tends to, do very well end of third quarter, beginning of fourth quarter. What is September typically like? I mean, is that normal?
It is. September is a good group month, but
Mm-hmm.
you also have to watch when the fall of the Jewish religious observances,
That's
Rosh
true.
Hashanah and Yom
Mm-hmm.
Kippur. My thinking right now, and again, we just wrote about this, is Rosh Hashanah will be less of an impact this year, even though it's in September, but it's on a Thursday. So that means you still have Monday through Wednesday to have meetings, which a lot of meetings happen, and you still have business trips that can happen, right? It would be more impactful had Rosh Hashanah fallen on a Tuesday or a Wednesday, right in the middle of the week. Then you really kill the group and meetings piece of the business of that
Mm-hmm.
week. And then Yom Kippur this year is on a Saturday. So that really should have very limited impact on any groups and meetings. Obviously, more leisure oriented or that piece, but not the big Las Vegas type groups meetings.
Mm-hmm.
So I think but September and October tend to be good groups. Well, that's the group
Right.
months.
Mm-hmm.
And so,
With
but
that
again,
variable,
you have to watch all the holidays though.
the holiday variable.
Yes, what goes on and and Halloween will be the other thing to watch for. But I think Halloween this year is also on a Thursday. So that means parents will be able to do their business trips and be home in time to take their kids trick-or-treating. Jan, can I go with you and your kids? Yeah, oh,
What's your costume?
me, data guy
Yeah.
from Tell Me More.
Little tinfoil hat, little antenna.
You can
Exactly.
to get pick up
Yes.
the extremely scientific radio waves coming from outside of our universe.
Yeah, exactly.
I
But
think
the Jewish
you
holidays, they're switching quarters, right?
Yeah,
yes.
they're on.
Yeah.
Yeah.
So that's a big that we had this big deal earlier, right, in the year with Easter shift, right,
Mm-hmm.
into Q1 and out of Q2, and next year that's going to reverse, right, and this year, and then we have the Jewish holidays now, which are going to reverse, I think, again next year. So just heads up, there's
Yeah.
lots of noise.
It's just important to watch, but again, what day of the week it falls, and
Mhm.
again, the latter part of the week is less it's still impactful because even my team members were saying it's going to be yes, it's still impactful, but it's less impactful because you can still travel for business to the beginning part of the week.
Okay, now it's time for my topic of choice for the month. And this one is kind of a fun one. Just made me think about, of course, we've been talking for the last couple months, the last year, about the bifurcation in the industry, how luxury upper up is doing so well, economy not so much. I was talking this week to a group of people who were not super familiar with the hotel industry, and I was explaining a little bit about luxury hotels. And the example that I used, which is one that I always bring up because I feel like if I look at the pictures often enough of the Amangiri in Utah, I will manifest myself showing up and
Yes.
being able to stay there someday. And Jan, I blame
One.
you for the Amangiri bucket list because you're the one who told me about it. But I always use this as my example, and I'll say, so luxury hotel, just take a guess. What the one I looked up my birthday, which is a Thursday night in October, what that rate was 1 month
Thursday is
from now.
probably pretty high season for them, right? It's going to be super
Thursday
tempting.
night was the
Yeah.
most expensive night of the week. And
Oh, okay.
can either of you guess what
I mean,
that?
it's 4 digits
It's
Yeah.
4 digits, and the first one starts with a
with a,
7.
excuse me?
Wow.
7,000 and change.
You
Yes.
deserve it, Steph.
You
Go
deserve it,
for
Steph.
it. Go
You-
for it.
And of course, this fact always blows people's minds, and they look at the picture and they say, but it's like an outdoor. I say, it is outdoor luxury lifestyle. Do not say the word glamping. But it made me think of, Jan, I know that you often look into data around hotels with ADRs of 1,000 plus a night. And I'm curious, what's the latest trend for these super, super, I would call that ultra luxury, but tell me more about it.
Yeah, the interesting thing about that data is that it's not that surprising. We have seen a slew of new hotel openings, and we have seen a slew of hotels that are now charging 4 digits over $1,000 routinely. And so I went to my friendly data person at STR, Isaac Collazo, and said, hey, can we just count the hotels that in 2019 had an ADR, not just one night, but an ADR of over $1,000? And he said, yep, roughly 150. Okay, let's do that again for this year. Oh, 450
Stop
hotels
it.
in the world have an ADR of over $1,000. In the Americas in 2019, it was roughly 50. Now it's 150. In Europe, it was roughly 50. Now it's 180. And we can then go out, into just specifically by country. In the US, it was 20 hotels in 2019. Now it's 80. In Italy, now it's 70 hotels. In France, now it's almost 50 hotels that have an ADR of over $1,000. And I think the asterisk to that data set is that some of these high-end, tented camps in Botswana or like a 5-room chateau in France may not be participating with us. So we may not actually know their data.
So
This data is
more.
probably understating the reality of ultra luxury, very, very high-end hotels proliferating because the traveler craves experiences and is willing, especially after COVID, to pay and say, look, multi-generational travel, or as you do, I deserve it, or saying, oh, the stock market's doing well, I got my bonus, let me treat my family. Whatever the reason, there are a lot of hoteliers out there willing to cater to that very, very high-end guest set. And I don't think that number is going to go down.
No, it's not. And one caveat with that data, not only did we look at the nominal basis, just like Jan said, where there's about 500 hotels now with $1,000, even if you adjust for inflation, there are still 3 times as many hotels now, or about 2.5 times as many hotels than they were in 2019 with $1,000 ADR. So it's growing immensely. And we were all very surprised. We started looking at this we looked at $1,000 ADRs right after the pandemic when people were just spending money left and right. But now you're just seeing these hotels that are consistently there, but they're all luxury, very luxury
And
hotels.
are they ones? I don't know if you could tell from the analysis that you did. Are they hotels that are new? I don't want to say new supply, but new online, or
Yeah, some of them I didn't
existing
actually
hotels that are raising rates?
I didn't do that. We can do that. We'll make it for a topic for another podcast.
The real
I didn't look
question
at when they
is,
became affiliated.
how many people can we fit into a outdoor luxury lifestyle, don't call it a tent at
Yeah.
Amangiri? Because if you divide it by
2.
15 of your closest friends, it's not so I know.
2.
I guess I'm gonna
Not
have to
15.
manifest. I'm gonna have to manifest a little bit harder in order to make this happen, and that will only scratch the surface.
Send us a postcard.
All right, guys, it is time to close up with our, now probably I would call it our favorite segment of the podcast every month, where I force both of you to give me and our listeners a comparison, a simile, a metaphor that describes to you what the hotel industry is like right now. And I swear, month after month, you guys manage to top yourselves and come up with something more clever, more interesting, more fun. So, Jan, start us off. I really queued you up there.
You really did. No pressure. I am very excited that my wife and I are going on a 10th anniversary trip. And I said, honey, I talk about hotels all the time. Which hotel would you like to stay in? And she said, I love you, but we're going to go on a cruise. So we are going to the Galapagos Islands. And so, of course, the only real topic for the US hotel industry right now, if I go to the Galapagos Islands, I have to talk about evolution.
Yes.
And how people adapt when it comes to room design or pricing strategy or marketing strategy. And we're going to continue to evolve to fit market need and to continue to hopefully change our pricing, and change our profitability as the year progresses. And I'm very curious to see how 2025 will evolve.
I love it. Now, Jan, those turtles who have lived for more than 100 years carry their homes on their backs, and they don't need hotels at all. So maybe that's the evolutionary cue we should be looking
Are they
at.
glamping? Do they have a tent with them?
I think they would call it outdoor lifestyle.
Right.
It's certainly an outdoor lifestyle. And if you consider all day long mud baths luxury, which I'm sure you can purchase at Amangiri Resort for probably $3,000. So I think this comparison is perfect. Isaac, what do you got?
Yeah, one thing, just for clarification for those listening, we were in the groups and meeting speech. We should have pointed this out. I don't think it came out clearly enough that we know that the Jewish holidays are in October. We know they're not in September this year, they're in October, but just we didn't point that out specifically. So I thought about that after we finished that segment.
I haven't even remembered that we're in September still now. So.
Yeah, I know. It's months. That's what happens when you work with data. You forget what month and what year. I once was asking for data for a month that hadn't happened, and the government was like, but that month hasn't happened. But my mind was already into that month. So that's how it happened.
That's
so
the curse of the data analyst.
Yeah, it's just crazy. You just lose track of time. I didn't know what to come up with, but I just came up with this because I think it goes back to everything we talked about this today, the blue sky, the interest rates, the boost of confidence. And so my word is audacious. And it's basically the idea of you got to remain audacious as an industry. We just got to get on. We got to just have that feeling. We know what we're doing. It's just a sense of confidence. Yes, times are rough, but you got to believe. You got to believe in yourself, and you just got to keep moving on. And so don't stop feeling audacious.
Don't stop believing.
Merriam-Webster Dictionary definition, showing a willingness to take surprisingly bold risks. There we go.
Be bold, and mighty forces will come to your aid.
That's exactly right. So I thought that was a good, again, as we look toward the future.
There's our.
And keep evolving.
And yes, I'm out of my funk. I'm now back at optimism.
I love it. You can tell that the tides are turning. As always, thank you both for your insight. Thank you to our listeners. We've been doing this for more than a year now. We realized that we had never celebrated our podcast anniversary, our podcast birthday. So maybe we'll have a fun little special celebration up our sleeves in a future episode. Stick around and find out. Find the latest global hotel industry news on hotelnewsnow.com. Find this podcast wherever you like to listen. And remember to find us and follow us on LinkedIn. Thanks, guys. See you next month.
Yes, thanks.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen and Lodging podcast on the Hotel News Now podcast network. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of Tell Me More, a hospitality data podcast, was recorded on September 19, 2024 by me, Stephanie Ricca. The episode was edited by Sean McCracken. Find all hotel industry news at hotelnewsnow.com. Subscribe to this and all Hotel News Now podcasts wherever you like to listen. Just search for Hotel News Now. Thank you.